In this video, we're going to break down exactly what a Roth IRA is and answer how it works so that you can protect your hard-earned money from taxes and actually build lasting wealth for your retirement. Let's get into it. So here's a quick overview of what we'll cover today. First, we'll talk about what the acronym IRA actually stands for and how the Roth version works. Then we'll compare it to a traditional retirement account so you can see the pros and cons of both. After that, we'll dive into the strict IRS rules, penalties, and income limits you need to watch out for. And finally, we'll talk about a very popular loophole for high earners. The basics. What actually is a Roth IRA? All right, let's start at square one. IRA stands for Individual Retirement Account. It's basically a special bucket you put your investments into that gives you incredible tax advantages. The word Roth comes from William Roth, the senator who helped create this specific type of account back in the late 90s. Now, the defining feature of a Roth IRA is that it is funded with after-tax dollars. That means the money you put into it has already been taxed from your paycheck. You don't get a tax break right now today, but here is the massive payoff. Once your money is inside the Roth IRA, it grows completely tax-free. And when you finally retire and start pulling that money out, you don't owe Uncle Sam a single penny on any of the growth. Think about how huge that is. If you invest $50,000 over a few decades and it grows into $1 million, that $950,000 of profit is entirely yours, no taxes. It's one of the absolute best ways to cure that anxiety we all have about taxes going up in the future. But before you get too excited, you need to understand how this stacks up against the other options, which we'll look at next. Traditional versus Roth, the great tax debate. So, how does a Roth compare to a traditional IRA? Well, a traditional IRA is essentially the exact opposite. With a traditional account, you put money in pre-tax. That means you get a nice little tax deduction right now, which lowers your tax bill for this year. The money grows tax deferred, meaning you kick the can down the road. But when you retire and pull the money out, you have to pay ordinary income taxes on every single dollar. A major frustration for people with traditional IRAs is something called RMDs, which stands for Required Minimum Distributions. Basically, once you hit a certain age, currently around 73, the government forces you to start pulling money out of your account whether you want to or not, just so they can finally tax it. Yeah, they really want their cut. Roth IRAs do not have RMDs. You can leave the money in there for your entire life, let it keep growing, and even pass it down to your heirs tax-free. So the debate really comes down to whether you think your tax rate is higher now or will be higher in retirement. But even if the Roth sounds perfect, the IRS makes it surprisingly tricky to use, and we're going to cover their rigid rules in just a second. By the way, if you're getting value out of this video, hit like, subscribe, and tap the notification bell to get more valuable content like this. The catch. Rules, limits, and penalties. Okay, now we have to talk about the catch, because of course there's a catch. The IRS doesn't just let you dump all your cash into a Roth IRA. First, there are strict contribution limits. Currently, you can only put in a few $1,000s a year. It usually hovers around $7,000 or $8,000, depending on your age and inflation adjustments for the year. Then there are the rules for taking the money out. A lot of people are terrified of locking their money away until they're old and gray. But here is an amazing angle most folks don't realize. You can actually withdraw your original contributions at any time for any reason without paying a penalty, because you already paid taxes on that money. However, if you touch the earnings, the profit your money made, before you reach age 59 and a half, you'll get slapped with taxes and a nasty 10% early withdrawal penalty. Plus, the account has to have been open for at least 5 years, which is known as the 5-year rule. The most frustrating part for high-earning professionals, though, is the income limits. The IRS tracks something called MAGI, which stands for Modified Adjusted Gross Income. If your income climbs above a certain threshold set by the IRS, you are completely legally banned from contributing directly to a Roth IRA. It feels like you're being punished for being successful, but stick around because there is a totally legal loophole to get around this, and we're looking at that right now. The Backdoor Roth, a loophole for high earners. Next, we'll look at what is commonly called the Backdoor Roth IRA. If you make too much money to contribute directly, you can still get money into a Roth. You just have to take a detour. Here's how it works. You make a non-deductible contribution to a traditional IRA. Since you aren't claiming a tax deduction on it, you don't face the strict income limits. Then, practically immediately, you convert that traditional IRA into a Roth IRA. It sounds like magic, but you have to be careful here because of something called the pro rata rule. Basically, if you already have a bunch of other money sitting in traditional IRAs that you haven't paid taxes on, the IRS will look at all your IRA money combined and tax your conversion proportionally. It can turn into an absolute accounting nightmare. So while the backdoor method is incredibly powerful for high earners who want that tax-free growth, you have to make sure you understand the tax implications before you just blindly pull the trigger. All right, let's summarize what we just covered. We defined what a Roth IRA is and how it allows for tax-free growth, compared it to the upfront tax breaks of a traditional IRA, went over the strict contribution and income limits the IRS imposes, and explained how high earners can use the backdoor method to get around those limits. What this means for you is that you now have the clarity to look at your own financial situation, evaluate your current tax bracket, and decide if taking a tax hit today is worth the massive peace of mind of having a totally tax-free bucket of wealth in your retirement. Quick reminder, I am not a financial advisor, and this video is for educational purposes only, so always consult with a professional before making major financial moves. If you want to keep learning, check out this video next. Thanks for watching, and I'll see you in the next video.